I'm not saying anything more, okay? All right, thanks a lot. Check those futures, please. Why not? Not much price action in the very early going this morning. Dow down maybe 50, NASDAQ up about 11. Michael Lee is here with us this morning. He's actually in New York City sitting next to me. Are we going to see a Santa Claus rally this year?
You know, we'll see. Everything kind of hinges on the price action right around here. We're at 4,000 on the S&P 500. That is a very key level for CTAs, or called commodity trading advisors. So they're basically the computers that give us all this whiplash effect. So if we get a little bit of strength, expect to see some buying. If we get a little bit of selling, expect to see the bottom fall out of potentially up to 200 points out of the S&P 500 right here. So
ooh, 200 points out of the S&P 500 at 4,000. I can't work out the percentages, but
yeah,
that would be quite a drop.
Yeah, that's almost a 5% drop right here.
Does it all hang on the Fed? I don't see how the Fed can ease up that much on its interest rate program when the economy is relatively strong.
So I would not say that the economy is relatively strong. I'd say the things that turn last, which are unemployment, okay, that is the last shoe to fall, and then inflation turns. So I think the Fed will, 99% chance, they will overdo it in terms of tightening, take the economy into a deep recession to stop inflation. Because if you don't stop inflation, you run the risk of, society and the fabric of society running apart.
So you really think they're going to do it? You think they'll go all the way, they'll push us into a real recession?
I think a recession is already inevitable. If you look at the way housing has turned and manufacturing have turned, there's been a recession 10 times out of 10. It typically happens a year after housing starts to turn, which was April and May of this year. So by the end of the first quarter, and that's coincidentally when a lot of the Fed rate hikes will actually start feeling in the economy. Remember, it takes 6 to 9 months before these Fed rate hikes really hit the economy. And so we were still at 2% on the Fed funds rate in August. So a lot of these 75 basis point hikes, the real economy hasn't really felt them. So I think that hopefully at some point next summer, late spring, we'll be actually feeling this recession. We'll see a bottom, and the Fed will have the opportunity to pivot.
You used to be Super Bowl.
Well,
you used to cut for years.
6 months.
Buy that thing, buy that thing, buy that thing. And now you're really pretty much the opposite, aren't you?
Yeah, well, look, I don't necessarily know that the bottom's going to fall out of the stock market, because stocks can be irrational for a very long time, and some of this is definitely priced in. But if you look at earnings for next year, the estimates for 5% growth, I think that could be off by as much as 15%. The fourth quarter estimates were 9.1% at the end of June growth. Now we're looking at a 2.1% decline for the fourth quarter. That's an 11-point swing. So we'll see how next year plays out. But with interest rates likely to stay stubbornly high, earnings declining, economy contracting, it's going to be hard, I think, for stocks to break out.
Consumers spending their savings, right? That's going to dry up by, Jamie Dimon is saying, early next year.
Mike Lee, no longer Super Bowl, but...
soon enough. Soon enough.
Turn it around at some point, will you, please? All right, thanks, Mike. That's where we're going here. Coming up, I'll tell you what's happening